With me today is Wayne Penello, President and founder of Risk Revenue Energy Associates, and Andrew Furman, Managing Director for Risk Revenue Energy Associates. You have co-authored a book set to release today titled Risk is an Asset, Turning Commodity Price Uncertainty into a Strategic Advantage. Gentlemen, thank you both for joining me today.
Well, thank you, Jessica. We're thrilled to be here.
Thank you as well.
Very good to have you. My first question, really, if we can just get started with, how can risk be an asset?
Well, that's a wonderful question. And I'd like everyone to think about the simple fact that in the United States, 40,000 Americans die each year in automobile crashes, yet almost every American drives. Well, why would we do that? Why would we all willfully engage in such a dangerous activity? It's because it allows us to create value in our lives. It allows us to get to work so we can pay our bills. It allows us to take our children to school or to their soccer games. It allows us to take our spouses out on a date and reinforce the wonderful things about being married together. So we take this risk knowing that it's there because it enhances our lives. So driving is an asset, even though it is a dangerous endeavor. Now the question is, how do you manage that? Well, when you get in your car, you turn the key, the engine starts, that's good. The no red lights on the dashboard, that's good. So the car's probably good to go. If there were red lights, it's probably something you'd want to check first. But with no red lights, you pull out of the driveway. And let's remember, we all have car insurance, but that isn't what keeps us safe. What keeps us safe is what we're going to do from this point forward. When we get out on the highway, what is a safe speed to drive? Well, if you're on the highway, 70 or 75 might be appropriate unless there's a lot of traffic. But if you're on a backcountry road, you'd never drive that fast. It would be quite dangerous. And if it's sunny versus a rainy day or night versus day, what we do is we use a process to take in the information around us to adjust our behavior so that we keep that dangerous, otherwise dangerous endeavor driving, we keep that safe and keep ourselves and our families safe. So what we're advocating here is that, yeah, we all need to take some risk in life to advance our station and quality of life. And we need a process to manage that, to make sure that we have a reasonable expectation that we'll be successful.
And can I ask, really, is that why the book begins by defining maybe the differences between a gamble risk and then there's calculated risk? We know, how does that help set up what you'll explain throughout the book, but really also, how is that relevant to today's environment, really, that everyone's trying to figure out how to navigate?
So the first thing is everybody uses processes in their normal course of life, whether it be cooking in the kitchen or driving, as we just described. But then there is the difference between a gamble, where there's no way to manage the outcome, or a managed risk, where you control the parameters, or an environment where you are using a process to manage the risk, and then you're turning risk into an asset.
Why did you write this book? Why did you both feel the need to do this?
Well, first thing I want to point out is the math can be complicated, but that's not this book. We wrote this book specifically targeting undergraduate level business students so they would understand better how to manage risk. I founded this company more than 20 years ago when I first started advising CEOs and CFOs of production companies on how to manage the revenue stream from the production that they owned. And what inevitably happened is they focused on price rather than performance. And when people focus on price, they get emotionally involved. And that impairs their ability to be logical. So I set out upon developing a methodology that would allow people to see through the haze of emotion and focus on the reality of the opportunity in front of them and make better, or at least strategic decisions that hopefully in the long run would prove to be a benefit. And in fact, the track record of our clients is simply astounding. They've done a tremendous job. Since 2008, we've seen oil have 3 downturns of 70%. And our clients have held up really well in each one of those downturns and been paid very handsomely for their hedges.
When we looked at all those books that are out there on hedging, they're really focused on derivatives, for example, swaps or puts or calls. And how you get these structures to offset risk. Now, Wayne and I and our team, we're options experts. We can help solve any kind of complicated problem when it comes to that. We have our DNA from the trading floor, so we understand how those instruments work. But what we felt was missing was enterprise hedging. The fact that, going back to Wayne's point, that businesses need to focus on performance. They need to focus on their enterprise as opposed to on how is a put going to work versus how a call is going to work. I mean, we advise to that extent, but it's much more important to really focus on the success metrics. And we felt that was lacking out there in the literature. The other thing is that when we spoke to industry executives, one of which, for example, was working for a large international exchange, these are people who are trying to educate their customers all the time to use their futures products. And they confirmed that, enterprise hedging books are not out there. So we really think that this can make a difference for people.
It really is good to hear. The more assets or tools, really, the better, I know, for people. So let's talk about how much risk is too much. Risk management, I imagine, of course, is unique to different situations. There's a lot to consider, including the overall business structure and its employees as well.
Well, that's a great question following Andy's highlighting enterprise-wide risk assessments, because as Peter Drucker said, what gets measured gets managed, and there's nothing more useless than managing something that doesn't need to be measured. And so you have to be very careful about what you measure. And so let's just take, to keep it in really general terms, everybody saves for a rainy day, all right? Whether you have, you're planning, you might have an unexpected expense or a car breakdown, or maybe you will be injured and can't work for a few months. So you need to know that if I didn't work for 3 months, I could pay my rent or my mortgage. What we put into that account is dollars, and we measure the account in dollars, but we should also measure that account in its utility. What does it do for me? You might, as a young person shortly out of college, would say, okay, I've got enough money in the bank that if I had a major car breakdown, I can cover that, but I only have 2 months of rent. Is that enough or not? Right? And they should be thinking about the utility of that account. So when we take an upstream company, and let's just keep it simple, let's say you have a producer that's going to produce 1 million barrels of oil this year, and oil's $40 a barrel. What they should be asking themselves is, how low can oil go? And if oil can get down to 20, they should ask themselves, what do I look like if my revenue is only 20 million, not $40 million a year? If that CFO decides, well, if we fall below $30 million, I can't service my debt, I'm going to have to lay off people, and I don't want that to happen. That means that they have $10 million more risk than they really can afford to have. So now when we're looking at this as what is the bogey that I need to achieve so that I can weather any storm? And in that particular case, if we need to close the gap from 40 to 20, lift that up $10 million to 30, that means we have 50% more risk than that company can handle. And we need to develop strategies that would allow them to close that gap so they'd have a high level of confidence they could weather any storm.
And I do have a few more questions for you outside of the book, but still really relating to today's risk and current events. The meltdown at sentiment, if you will, the settlement rather of the May WTI contract. Volume indicates that were actually very few trades at sub-zero that day, but the posted price followed those trades. Tell us why a speculator was still holding on to the paper oil for May delivery, as late as that. Is that naivete, or what do you attribute that to?
What happened, interestingly, was that when we went back and looked at the open interest was a lot higher for that May contract. This is back in April when we saw those negative numbers in WTI. And I think that just from a volume perspective, there just were greater amounts of people still holding positions that needed to get out of that contract. And so they ended up having to get out at negative prices because there just wasn't enough demand. I think that what we can do is we can look at the issue fundamentally and technically. Fundamentally, this was something that was taking place over about 3 months. First, actually going back even to December, You had the Saudi Arabians doing their IPO and trying to hold oil prices up. And then in January, the issues with Iran and Soleimani. And then once that was resolved, now all of a sudden, I think that it kind of put more of the onus on producers getting a little bit more active, in OPEC plus. And then on top of that, now we had COVID that started to strike, and by February and March, we started having some demand questions. Even in back in January, there was less air travel going on, and as we all know, crude oil, part of that barrel that gets cracked into jet fuel. So we were losing demand from jet fuel. And then by March and April, we were losing demand from gasoline for automobiles because people weren't driving to work anymore because of shutdowns. So from a fundamental perspective, demand is coming off. And then in March, on top of all of this, we actually had a price war with Russia and Saudi Arabia. And so all of these things are starting to flood the market with extra supply. And so storage ends up getting spoken for in the weeks prior to this contract melting down. So it wasn't like this thing happened overnight. There was a certain amount of warning that this could actually happen. And then technically, to your point about these oil contracts that were there, Jessica, greater than normal open interest, people couldn't get out. And now all of a sudden they had to get out at any price because they can't hold the futures contract to delivery.
My next question, United States Oil Funds LPs business model. Let's talk about that. It seems as if investors didn't understand the investment is in next month's barrels, maybe actually holding on to barrels until the price gets better. The paper barrels get sold on schedule each month. We know at whatever the market price is. Does it concern you the volume of speculator paper floating around for WTI?
Yes and no. It used to concern me more than it does now, and I'm going to explain to you why. It used to be that all of the volume, as you say, was concentrated in the front month, and everyone knew that they had to roll all of that volume into the next month, into the second month. And so almost like they were like, for lack of a better word, sitting ducks. And together with this, perfect storm that we had back in April, they were the mullet, they were the target, and they actually had contracts that had to get rolled. And the CME, who oversees the NYMEX contract, they were the ones who basically reset the rules for the USO, for the ETF. And what they did was they made them push back the contract duration so that instead of owning the contract in the first month, now they're owning it in the second month, 20%, in the third month, 20%, in the fourth month, 20%, and actually even as far out right now, October, November, December, out to June of 2021. So because of the fact that those contracts are now spread out more broadly in the backs, it's a lot safer for everyone now. I'm not going to say it's completely without risk, that there could be problems with this ETF, but far, far safer now than it was before.
Thank you for that, Andrew. Let's talk about producers, if you can. Explain to us how producers are continuing to collect $40 or whatever, maybe per barrel right now on their hedged oil, even if they aren't producing it. Are those the luckiest producers of all, the ones that hedge in this great day, of oil supply? Is it luck or just good business practice to really be hedging? Is this unlike pre-shale days?
The answer is unique to each company. I mean, obviously, in a world where prices are lower and margins are tighter, many companies need to hedge more than they would in a much higher price environment where they have larger profit margins. But there are some producers who can choose not to produce because the price they're selling their physical molecules for is less than their cost of production. And so they have the opportunity to not spend $30 to pull a barrel of oil out of the ground that they're selling for $20. And yet they still have hedges at $50 that are paying them the difference between 50 and 20 bucks. So they're making the full 30 instead of only the gap between the hedge price and their production cost. it's hard for producers to do that as a reality. One, because if they shut in a well, they don't know what's going to happen when they turn it back on again. They're not always confident that's going to come back as strong as it was. And then there are some leases that are held by production, so they just have to produce it, or they suffer other financial consequences.
If I can ask a final question of you both, with your experience in the industry, what do you see as the path forward from here for the oil and gas industry? With leaning on your book and the information that you have there, but then also just your knowledge of the industry as we move forward through these times.
I think that you want to consider the life cycle of any industry, and the oil industry is maturing. That is, in the early days of wildcatters, you could take a great deal of risk because if you found that well, it was going to pay you very, very handsomely. And then as more competition came in, you had to be a little bit smarter about it. And when I first started working on the physical side or with physical companies here in the business, when people were drilling in the Gulf of Mexico as their primary source of new developments, to have a 25% success rate through the drill was unbelievable. You were a superstar. Today, with infield oil drilling and with frac plays, the expectation is if you're not hitting 90%, you're doing something terribly wrong. So we have gone from a wildcatting business to a manufacturing business. And you've probably heard that term in many other places. And with manufacturing, competition comes in and margins get tighter. And these companies are going to have to put themselves in a position where they have more consistent control over their margins and their cash flow.
In terms of business models, there's also going to have to be a change that's afoot, where we've got businesses that are, proving up the acreage, like Wayne explained. They use debt to do that, and it doesn't really matter if they're leveraged, because this is an advantage to them to be able to use that risk to basically prove up that asset. Problem now is that with prices going down, their economics are underwater and they have too much debt, and so the business model is going to be changing to one where they have to be cash flow positive.
An elegant way to describe this is that going forward, companies are going to have to manage themselves for resiliency rather than trying to maximize the opportunity. They need to set themselves up so that they can weather any storm and know they'll still be in business at the end of the year. Because directly to Andy's point, it used to be that the asset was what was in the ground. Now the asset is your ability to get it out of the ground. And that means you need people and technology. And so if you're not protecting your culture, your core team of employees that enabled you to develop, find, and exploit this asset, then you really are rolling the dice with your most important asset.
I thank you gentlemen both for joining me today, and we are pleased to be able to get to discuss this with you. I know I can speak for myself and Hart Energy to be able to discuss your book, but also your expertise in the industry. We wish you all the best. Thank you very much.
Thank you for this time. It's a pleasure to work with you.
For more Hart Energy videos, follow our social media channels.